Welcome to the Big Mike Fun Podcast, where you'll learn about advanced wealth building strategies from real estate investing to creating massive ROI and secured retirement profits. So pour yourself a cup of coffee, grab a notepad, and lean in, because Big Mike has got the mic, starting now.
Welcome to the Big Mike Fun Podcast. I'm the Big Mike Zlatnik, and today it is my pleasure and a privilege to welcome back my very good friend, Eric Goodman. Hi, Eric.
Mike, it's great to be here. Thanks for having me.
Thank you very much for coming on the podcast. Eric is a partner in Goodman Capital. He lives on the Upper East Side, Manhattan, and he runs, as I said, Goodman Capital, and married, a couple of kids. I don't know if you got any cats, pets. Just tell us a little bit about the family first, and then take it from there.
Sure. Well, I have two beautiful little angels at home. Oldest just turned 3 on Halloween, and my youngest is just turning about 15 months. No cat yet. Hopefully a few more kids before the pets come.
Yeah, that's right. So we got the cat after having 4 kids. So you got a little room to run. After a couple more kids, you'll think about the cat, right?
Yes, you're ahead of me, Mike, by 2.
That's right. So just tell folks a little bit about, refresher, what Goodman Capital does, kind of a little bit about you, and then we'll talk about a very exciting project that we are working together on the Upper East Side, on East 73rd Street. But before we do that, just a couple of words, refresh folks about Goodman Capital and what you've been doing for the last however many years with your father.
Absolutely. Well, Mike, again, thanks for having me on. I'm the manager, as you mentioned. I'm the managing partner of Goodman Capital, a New York-based multi-generational real estate investment firm specializing in real estate-backed debt. As a real estate family business, we've been active investors and lenders in our local New York City real estate market for over 30 years. My parents started the business back in '87, have seen many market cycles over the last 30 plus years. And since 2015, I've been overseeing our credit committee, allocating across primarily first position liens on commercial real estate assets all throughout New York City and Eastern Long Island. And we invest primarily in senior position loans, and through our extensive lender relationship network with many of the local private lenders, conventional bank lenders, we've sourced a real attractive debt investment that has actually evolved into a very attractive value add redevelopment opportunity that I'm excited to chat with you about today.
Yeah, that's great, Eric. So appreciate the introduction. Let's jump into this property. So that property you bought a senior debt on and taken through a foreclosure process, and it's coming to a foreclosure auction, and it's going to get bought out from a foreclosure at a good price for the fund that you operate, and then for the new endeavor, which we're working on together. So let's just talk a little bit about the numbers. Kind of, you acquired the debt. Remind people at what cost basis it was, around 16.5 million, if I remember correctly, and just talk a little bit about kind of getting this asset sourced and kind of the path forward.
Sure. Well, as I mentioned earlier, we source many of our loan investment opportunities through our extensive lender relationship network. So we're typically the top 1 or 2 calls for most of the private and community bank lenders, and then of course the alternative lenders here as well. So in 2019, we acquired the first position lien on this property for about $16.5 million, which had been originated from another close lender relationship of ours. Now, our business is specializing in the distressed credit space. So we buy non-performing loans secured by these types of mixed-use multifamily commercial assets. And utilizing our integrated platform, we're a team of 10 over here, we take these investments from cradle to grave. We're a team of investment professionals, legal professionals, and then property management professionals. So leveraging that platform, we took this loan from acquisition through the full foreclosure process, and that sale is now culminating in early December. And now, because of our involvement in this transaction and our deep knowledge of the asset and how it's going to be reconverted, we're really sitting with one of the most seminal townhouse assets here in what we call here in New York, the Gold Coast of the Upper East Side, ready to be redeveloped. We'll be picking up the property for about $22.5 million, which is an implied $1,500 a foot cost basis. Now, the townhouse is about 16,900 square feet, unrenovated, but combined. Now, comparable assets of similar types of townhouses, unrenovated, are trading for right around $2,000, $2,100 a foot post-COVID. Pre-COVID, we were looking around $2,200, $2,300 a foot. So market pricing has really caught up. But because of the unique sourcing of acquiring this loan out of a bankruptcy proceeding, we're able to source this opportunity at a nice 20, 25% discount to market comps. And that's what really provides a real attractive entry basis for us to now take the asset to the next level through a redevelopment and execution of and conversion of the property into a luxury high-end townhouse here in one of the seminal quadrants of Manhattan.
So let's talk about that. So how much capital has to be invested to redevelop this multifamily asset? And again, let's go back in history and just cover, this used to be called Grace Kelly Mansion, or Grace Kelly used to live there, and other celebrities. So it used to be single family residential. Then it got converted at some point to the multifamily, not really used here as a multifamily. If I remember the history, it was planned to be used as some kind of a school for underprivileged kids, and somehow the historic committee didn't approve it. So just walk through a little bit of a history, and then let's talk about what the renovation budget is going to look like and what the final product is going to be like.
Sure. So let's just take it. We'll step into the time machine and go back to the late 19th century. This townhouse today was originally erected as two distinct townhouses back in the late 1880s. Now, here's what's really interesting. If you're looking at Manhattan's history, the avenues circumscribed, or the neighborhood circumscribed between Fifth Avenue to Park Avenue, 59th Street, up until about 79th Street, which today we call the Gold Coast, really was the main area of affluence in New York City. And so most of the assets and properties built at that turn of the century were all single-family townhouse residents. And then the avenues occupied and the location occupied east of Park Avenue used to be utilized as the carriage houses for the wealthy families living in the more premier Gold Coast of the Upper East Side. Now, when these two townhouses were built in the 1880s, they were subsequently converted into and combined into a single tax lot, a single property back in 1947. Now, just a few years later, 1965, New York City created an organization called the Landmark Preservation Commission, the LPC, which was formed to preserve the historically significant buildings of New York City. And certain swaths of the city have been considered and reclassified as historic districts. So, for example, the Upper East Side Historic District, the West Village Historic District. East Village was really more of an up-and-coming trendy place. There's not much in the way that's landmark or designated historically significant buildings. But here in the Upper East Side, everything from Fifth Avenue to Park Avenue, the premier Tony area of the Upper East Side, which falls today in the historic Upper East Side Historic District, is governed by the LPC. Now, one of the primary initiatives of the LPC is to ensure that things like facades, the front image of the building, the rears, the streets, the use of the property is restricted to avoid a massive conversion or redevelopment into large towers and condo product, and to really preserve the antiquity and historical and architectural significance of these neighborhoods. So that effort led by the LPC has created a real structural deficiency and structural impediment, I should say, of comparable double-wide townhouses, which you find today are assets that are in existing form post-65 that didn't have a history of being utilized as single family, have difficulty converting back to that use. Similarly, assets that have not been combined post-65 have real difficulty combining into these types of double-wide townhouses. So this unique asset is 35 feet in width, which is only made possible because of the conversion of two 17.5-foot wide townhouses that were combined back in 47. Today, you could not recreate this asset. You have difficulty. It would be about a 2-year plus process to recreate just the structure and combine into a single asset, let alone the redevelopment time to actually demo and reposition the asset. So we're really sitting in the seminal quadrant of Manhattan with an asset that has real structural impediments to even be recreated in today's market. And that's one of the reasons these types of assets, even unrenovated, are trading for such a hefty premium of around $2,200 a foot just because of their scarcity and structural limitations in recreating them today.
That's great. That's awesome. So that's the history. By the way, who are the people who used to be in this house besides Grace Kelly? There was a prince somewhere, one of the princes, and just a couple more names.
Sure. Well, it is a very storied neighborhood. So we're talking about one of the seminal quadrants off of Madison Avenue and 73rd Street. Typically, the 60s and 70s, historically going back a century, have always been the most Tony and ritziest areas of their Upper East Side. So going back to the early part of the 20th century, this was home to Grace Kelly, Harry Belafonte, Prince Rainier of Monaco, and a few other luminaries over the history of this property.
Thank you for sharing that. Now let's continue with this property. So we have a unique asset, and we're working on this project to basically, and we'll bring in a few really critical partners. So to redevelop a project like this, you and I don't have the name recognition to do it in the city. So it's critical to bring in big name architect and a big name developer. So we're bringing in some very prominent architect and a prominent developer, and they're coming in as partners in the deal to make sure there's alignment of interest. And not only that, they're bringing in capital. But now let's just, before we get there, let's talk about the redevelopment path. So this thing is naturally now approved to be redeveloped as a single family townhouse. We don't have a difficult process through the Landmark Preservation Committee. What is it going to look like? What's the budget? How much money this redevelopment will take, and what is it going to look like a final product? Just let's just cover that a little bit.
Absolutely. Well, the building today is broken out into 20 apartment units. As you mentioned, because of the historical use of the building, and given the fact that we're not, and given the fact that it was converted pre 65 formation of the LPC, this is about a 2 to 3 year project from closing on the purchase to final C of O and sale, which is unheard of in Manhattan, and really one of the unique benefits of coming into an asset that has its history as a single family townhouse and converted pre LPC formation. So over that 3 year period, we're going to be converting this existing vacant multifamily townhouse into one of the premier newly renovated single family townhouses of double width in New York City. And to do that, we're going to be utilizing a capital structure broken out between an $8 million equity and $32 million of debt. Now we can talk a little bit about the cap structure, but Mike, one thing you really alluded to earlier, which is so critical about this particular investment, is the alignment of interest. So just off the bat, Goodman Capital will be providing the $32 million of debt, which is broken out between an acquisition loan of $18 million and a $14 million construction loan. Those will be offered at very attractive low rates of about 7%. One of the reasons we want to be the lender on this project is so that we can control and make sure that there's no funny business from any of the other private lenders in this community. And one of the reasons we need to make sure that we have an airtight control over the debt financing is that my family is coming in for one of the largest pieces of the equity as well. We're coming in for $1.5 million on the equity. So taking one of the largest equity chunks already is unheard of for a lender and just shows you that intrinsic alignment of interests. Now, for your viewers, I'm sure they'd love to know, and Mike at TF Management will be coming in for a big chunk, as will the architect and the developer coming in. So the most critical facets and critical components to the success of this project are intrinsically aligned in this investment because they comprise, as we do, the majority of the equity investment coming into this project. And in fact, because of that alignment of interest of the $8 million equity raise, we only even have $2 million left to be offered. The residual will be occupied, it's been taken up by you, myself, the architect developer. So this is really just that last cap off for folks who'd like to participate in really a unique seminal project of New York City's redevelopment, with a small remaining equity piece that we still have left to raise. But with that $40 million all-in capital budget, we're projecting an exit of approximately $65 million plus for this single-family townhouse, which is consistent with recent transaction comps of newly renovated product all in the last 6 to 9 months. Because here's what's actually happened post-COVID. In the pre-COVID environment, much of the affluence and wealth concentration in New York City was centered around the new luxury condo product. Folks want to live in these massive high-rise towers, full-scale amenities. new glass, city and steel, views of Central Park. And what we've seen post-COVID has been this surge and rush for product that can deliver privacy, safety, and security. And there's no other asset class for those affluent and wealthy enough to buy those luxury condos for $5,000 to $6,000 a foot. There's no better asset class than a single-family townhouse. That gives you the utmost level of control over your environs, limiting your exposure, and that focus on security and safety has really been a primary driver for the uptick in transaction activity in the townhouse market we've seen post-COVID. And the last 4 or 5 transactions to trade up in the Upper East Side in the Seminole Gold Coast quadrant have been all for around $3,700 to $3,900 a foot, which implies right around a $53 to $59 million exit value, and that's for renovated product in the last 10 to 12 years. This project will be one of the first assets, double wide assets, to be renovated by the time it's complete in the last 15 years, will be the only double wide newly renovated product of its kind. So just even applying those multiples of more dated renovated product puts you easily at a $65 million plus exit valuation, which translates to about a 25 to 30% annualized return from start to finish.
That's great. That's a lot of critical nuggets. And just to reinforce, this is a podcast. We're not soliciting anything at all. We're just talking about a project. By the time this thing airs, we probably will have raised the $2 million. So we're not looking for money. But if you have interest, then you feel free to reach out to Eric or me, and we'll have a conversation. Obviously, we'll have to send you, if we have space left, we'll have to send you offering memorandum and, to accredited investors only, the usual spiel. But this is a podcast. This is not solicitation. So just to recapture one of the key points that, and I don't know enough people in their choices, but having a 2-floor penthouse where you pay $65-70 million for a massive penthouse on a very high floor, you still don't have a privacy. You have a big building, but it's not your house. Versus you actually own the entire real estate in a location that's as good as it gets. It's about a block and a quarter away from Central Park, and as you call it, Gold Coast. But let's talk about renovation, right? The process itself. So $14 million renovation. What do you do? I mean, I'm just trying to think. Do you put? Is it we're gonna do down to the beams? Everything is gonna come off, other than the studs and the key structural support of the building. All electric, plumbing, everything is gonna get replaced, and as well as ultra high finishes, and then obviously the design that will be basically, it'll be like a mansion. 17,000 square feet. It's, if you think about it, if you go anywhere outside of New York City, it usually is considered a mansion. In New York City, it's a big townhouse.
No, it's true. And it's funny. This ties back actually, Mike, to one of the comments you made earlier about the team. Maybe I could just take a quick sec to talk about the parties involved, because as you mentioned, Mike, I wouldn't necessarily trust you and I with a hammer. Maybe you more so than I.
No. I think you'll do better than me. But
so much is rooted in the development team. It's been very interesting. We have financed construction rehab for years, for 30 plus years. And one of the most critical facets to this, coming in as one of the largest equity pieces, is building the right team that can take this from start to finish. And like you said, what do you do for $14 million? Well, you demo, you got the building just about down to the studs. You're going to remove all the floor joists, because you're really cutting up an apartment building that was converted into in a townhouse structure. Now you're making it back to a single family townhouse. And we're going to be able to utilize over 16,800 square feet of space, and now convert that into likely a 7-8 bedroom palatial estate. Now, this is all being made possible because of the team that we're bringing together. Like any project, the quality of the team is always a critical factor in projecting the performance of any investment. And I'm thrilled to say, as you know, Mike, that we've put together a first-class development team led by Rad Studio. Rad Studio is run by James Ramsey, who's a renowned local architect of premier residential townhouse product, and has built homes for some of the wealthiest tech entrepreneurs, financiers, celebrities, luminaries here in the city, and is single-handedly responsible for cracking 3 records of townhouse sales in the Upper West Side. Historically, pretty much the Upper West Side saw a cap on exit value right around $1,900, $2,000 a foot. And just in the last 6 months, secured 3 Upper West Side townhouse sales reaching $2,200 to $2,500 a foot. And one right now is about to get into contract for over $2,750 a foot. And it's a function of the quality of his craftsmanship that has really been unseen in the spec basis. Most of most of his clients usually they'll hire a high-end architect development team for a custom, which means they're living in it, they're utilizing it as an end user, but he's working primarily on a spec basis. And that's where this level of craftsmanship is completely unheard of and is about to blow up the entire Upper East Side.
Yeah, that's critical, and that's awesome, because without a big name developer and big name architect, the project is just a project, and this will be a priced asset. Effectively, I think you mentioned this. It's going to be one of the top 10 townhouses on the Upper East Side, and maybe over the entire Manhattan. It's 35 feet wide with that kind of a size. And so who would buy this thing? It would be essentially a technology moguls. It'd be super hedge fund managers on Wall Street, maybe a Saudi prince. I don't know. Maybe I don't know who typically who buys this product. Just curious. What are the typical acquisition? Isn't it not far from what's that guy Abramovich house, which is basically, he's a billionaire, Russian billionaire who bought Chelsea. I think he owns one of the large soccer teams, and he needs a home in New York. So,
and funny, he bought a 4 townhouse assemblage next door to a loan that we actually own, and his all-in basis. Now, he was very generous. He sold it to his ex-wife Dasha Zukova for only $5,000 a foot, or $74 million. It was a very generous transfer. But that's not even completed product. And he learned firsthand the difficulty of LPC. He was trying to combine 4 townhouses comprising 3 distinct architectural styles. That's a big no-no for LPC. LPC is all about preservation of the historically significant architectural buildings of the city. And he's been in that project for about 6 years and still doesn't have a completed building on his hands. That is exactly the travesty that can befall you if you don't know what you're getting into. And again, just to take it back to this particular project, having had it converted into a single structure is saving years and years of time off the construction timeline. That's really going to add to the accretive value of the investment.
That's right. It limits the supply. The LPC essentially limits the supply of the product unless it meets the LPC requirements. So when this becomes a product that has almost no competition or very limited competition, it becomes a very interesting opportunity. So just kind of final thoughts. $65 to $70 million. Why not 80? Why not 50? And these arbitrary price per foot numbers, they're big numbers. And to most people outside of New York and maybe some other big cities around the world, these numbers sound like who pays these prices? And the numbers so wide and broad is almost the people who buy them, they don't even care. If they have a great finished product and they don't have to deal with renovation and LPC, why can't they pay 80 million? And why can't they pay a bigger number? Because they get into a wow factor. They enjoy the wow factor. They enjoy the finished product. And to them, it's almost like the sky's the limit. So it does have sort of a practical flaw, but on a higher side, if the market supports it, this could even sell for more than what we're saying, 65 to 70, right?
Oh, absolutely. The 65 to 70 is just based on actual comps in the last 4 or 5 months, which are all renovated in the last 15 years. There's no new renovated product of double wide townhouses in New York City. We would be the first seminal townhouse to be sold, again, on a spec basis, because most of the newly renovated are all custom jobs, not available for sale. We would be one of 2 townhouses of double width even available that can be delivered vacant at sale for the next 5 years. And the only other townhouse that could be converted is actually still 2 distinct townhouses. So the jury's still out whether LPC would even allow them to combine and convert from 2 into 1 assets, because they don't have a history of being a single family townhouse. So on that note, really, our particular project would be singular of its kind. Now, the 2 points actually, Mike, you mentioned, and this has really been interesting to see post-COVID, the premiums being paid for finished product. There is a plethora of transaction activity in the townhouse market for unfinished product. That $2,200 a foot, that's based on over 40 comps that have traded this year. That's a very healthy market for generating real price discovery of where unfinished product is trading for. Now, the 5-6 comps that have been double wide renovated in the last 15 years, those have been a real uptick just in the last, as I mentioned, 4 or 5 months, seeing where they're trading. And really interestingly, they're not being bought by foreign money. One of a few of the factors we look into, obviously, is transaction activity and who's buying. Those are 2 big indicators of where the market is shifting in New York City. And I'm really pleased to say that the largest purchases over the last 4 or 5 months have all been from American buyers. When we use the word working professional, we mean as you mentioned, the hedge fund titan, the Goldman Sachs partner, the Brevin Howards of the world, the $500 billion private equity firms. These have been the buyers of these kinds of assets post-COVID, and it's very encouraging because it shows it's real American money making these purchases. It's not foreign capital that is looking for any place of shelter, and that gives us a little bit of a clue of where the market is for some of the wealthiest New Yorkers, and only adds to the available liquidity and exit likelihood of hitting a really high-end target when we're ready to sell, because our exit buyer universe is not just the foreign capital. Certainly it will be, because this will be the seminal product of its kind, but it's also the local wealthy New Yorkers and Americans who've made quite a bundle with the whole crypto craze in the tech space, in finance. There's a very large buyer universe that we have seen demonstratedly has been willing to pay these $50, $60, $70 million price targets for finished product here in this Gold Coast of the Upper East Side.
Yeah, that's a great point. With the things you mentioned, the Wall Street is doing really well. The crypto world is doing well. Technology in general is doing well, and there's enough U.S.-based demand that the foreign demand doesn't even have to be in the consideration. Anyway, we are, as I say, all good things must come to an end, unfortunately. So this podcast is coming to an end. Appreciate you coming on the podcast once again. Any final thoughts? And if folks wanted to reach out to you, what's the best way? The website, just quick share and just share, please.
Sure. So the best way to reach out to us would be through our website at goodmancapitalllc.com. You can reach us through invest@goodmancapitalllc.com. One quick final thought, Mike, I think always is important to share is, you and I share a mutual ethos, and the way we think through underwriting is very much in line, which is why I think we've stayed friends throughout the years. At the end of the day, whether it's a debt or an equity investment, it always comes down to basis, and basis is always going to be your friend in a market downturn. It's what always provides downside risk protection. And what I love about this particular investment is that even at an all-in cap stack of 40 million, you're still in at about $2,500 a foot, which is just a slight premium to where existing unrenovated, less than double wide townhouse product is trading. So the replacement value of this is far in excess of where our all-in cost basis will be. And that's a big function of how we source this opportunity at such a below replacement cost acquisition entry price. So by coming in at 22.5, having the right team that can streamline the construction, value engineer the hard and soft costs, we're in at a basis that you couldn't even pay to replace if you want to build what we're going to build on this product. So by virtue of that, that's what provides that downside risk protection, that I could be selling at the same price for unrenovated, smaller townhouse product, and we still have more than enough cushion to not lose capital on this investment. So again, I always relate it back to basis, and coming at this kind of product would trade for double where unfinished product were. But should the market turn, should interest rates rise, and I don't think they are or certainly not aggressively anytime soon, but in the unlikely event that we do see another period that looks like a black swan event, our basis is just in line with similar types of assets pre-renovated and much narrower. And it's really that below replacement cost basis that has always provided us downside risk protection throughout our investment track record. Yeah,
that's a great point. Very much appreciate that thought. We were to quantify this, our cost basis is around 65% of what we'll project to be future price. It's almost like it's an equity investment, but all in 65% of the future value. It's a really healthy ratio. So appreciate your wisdom. Thank you very much again for coming on a podcast, and all good things do come to an end, and so does this episode.
Thanks for having me back, Mike. Appreciate it, bud.
Thank you, Eric.
Thank you for listening to the Big Mike Fund Podcast. To receive your copy of Mike's How to Choose a Smart Real Estate Fund book, head to BigMikeFund.com or visit Amazon and type Mike Zlotnick. Keep listening and keep investing Big Mike style. See you on the next episode.